Hi there, my name is Chris Cam with Mining Journal. I'm here with Hayden Locke, Chief Executive of Moroccan-focused potash play Emmerson. Welcome, Hayden.
Thanks, Chris.
If we can start, recently you put out a resource upgrade. What does that mean for your plans at Chemisett? And if you can also put that in the context of the broader project and the feasibility numbers that were out not so long ago.
Sure. So we're developing the Chemisett Potash project, which is located in northern Morocco. As you mentioned, scoping study out last year, which really confirmed what we had thought, which was this is among the lowest capital cost, potentially among the lowest capital cost potash projects in the world. And as a result of its location, very, very competitive on a delivered cost basis. We did put out a resource upgrade. So the original study, which contemplated a minimum 20-year mine life, is based on the smaller resource. So obviously this resource upgrade will likely have the impact of increasing our mine life. By how much, we don't know, but it was a 70% resource increase, and it seems to hang together pretty well. So we're hopeful a lot of that will be converted into the mine life extension that will come out of the feasibility study.
Okay, and the scoping numbers, MPV, CapEx, what were those basic numbers just for investors to get a handle on what you're doing?
So the total pre-production capital cost was $406 million, including a 30% contingency. So the contingency was around $95 million, so quite a lot of margin of safety there. To put that into context in the global potash industry, the last potash mine that was built was a bit over $4 billion. So we're less than 10% of the total CapEx for that project. We are, in general, about a quarter of virtually every other potash project in terms of absolute CapEx, and we're less than 50% in terms of capital intensity. So a very, very low capital cost project. Now, saying that, $400 million is still a relatively large capital cost in today's market. So the benefit that we have with being such low capital intensity is we can potentially do a much smaller starter project and still have our economics stack up, which is not true for many of the other projects that have very, very high fixed capital costs, i.e. $1 billion if you produce 1 tonne of potash, or 5 million.
Okay.
So they tend to chase after these bigger projects, which exacerbates their problem. So we will eventually start looking at how do we slice and dice this project to make it a little bit more bite-sized. But for right now, we just want to present what the optimum size we think project is.
Okay.
In terms of NPV, that delivered us an NPV 10 post-tax of a bit over $1 billion, so pretty outstanding numbers. For a very long-lived industrial project, IRR of about 30%, which is almost unheard of. I mean, it's an outstanding project, there's no doubt about it, and we're flying very much below the radar at the moment. I think what I liked most about the project, though, was its robustness of its cash flow generation at the lower potash prices. Okay. We see a lot of volatility in the market, as with all of the other commodity spheres. Ongoing trade wars and things like that are causing some dampening on the price and some volatility. But if we look at the price that is the lowest that it's been in the last 15 years, at that price, this project will still make $80 million a year of post-tax free cash. Okay. It's an incredibly cash generative project in the downside. In the upside, it's obviously significantly more than that.
Okay, and you're already looking at another release out, looking at the Port of Casablanca, taking out $7.5 million, the resource upgrade, obviously building on those underlying numbers. What else should the market be expecting before you publish the feasibility numbers?
So we're breaking the feasibility, as we did with the scoping study, into those discrete pieces, and you reference the announcement about the port. We've actually switched ports, so from Mohammedia to the port of Casablanca. Casablanca is a much larger port. We did that primarily because it's larger, it can take larger vessels, but also the added benefit of having no necessary capex to upgrade to allow us to be able to export product. The other things that will come out, transport and logistics connections, so how do we get our product onto the roads that take us to the port? That's a standalone announcement. Electricity connections, and then decline. We'll put out an announcement on the decline capital cost. That's one of the most important drivers of this being a low capital cost story. So that's going to be a huge piece of news for us that will really confirm our view that this is a low capex project. And then leading up into the feasibility study, which we've said will be out in the first half of next year. I hesitate to say that it's going to be ahead of schedule. But it's looking like we will certainly be able to comfortably meet that timeline.
Okay, and you mentioned the low cost and that being a fantastic part of the project. Is that essentially why you feel that you'll be able to break into a potash space which is essentially dominated by a few very large players, and they've managed to keep most other smaller companies out of that market. Can you explain the difference in the costs from the mine gate and then to client and how that works?
I think the biggest barrier to entry for potash, rather than being the incumbent producers, is actually the capital cost, the average capital cost of a typical potash mine. I like to refer to the ratio of capital intensity to the commodity price is so far out of whack compared to all of the other commodities that, all else being equal, it takes 3 or 4 times as long to pay back the same dollar of capital cost in potash.
Okay.
As a result, in anything but a very high potash price environment, it's almost impossible to make an economic return on your invested capital. And that is the biggest single block for new companies entering. If you look at BHP's Jansen project, $15 billion of capex for 8 million tonnes a year of production, that's a $2,000 a tonne or thereabouts capital intensity against a potash price that's $300 a tonne. It's a very, very difficult business to make money in. In terms of the structure of the industry, what's really interesting in the work that I've done on it is the cost structures of the industry is that transport, logistics and royalties over the whole potash industry makes up about 60% of the total cost delivered to the customer, which is really instructive when people start talking about very low-cost mines. Well, I don't really care about your low-cost mine. I care about how much it costs you to get to your customer. If your customer's next door to you, on your doorstep, and you don't have those transport and logistics costs, you don't have that massive royalty burden that you see in Canada, you have an unassailable competitive advantage that puts you in a great position to enter a market, and they don't really have any ability to keep you out, because it's a competitive advantage that lasts and actually potentially gets better as freight rates increase.
And I did need to ask you about financing and then the logistics and the path to building Chemosit, but it feels, given that you have a major international fertiliser company in OCP pretty much next door, the question might be better phrased as what are the chances that you'll actually have to build it before they buy you?
It's a question that I get quite a lot. OCP, as you point out, are one of the largest fertiliser companies in the world, the largest phosphate rock producer. They have a very large facility in Jor-Phosphate, which is about 300 kilometres from our site. Over the last 6 years, Morocco has been top 5 fastest growing import nations for potash, growing at about 120% per annum compared to a global market that's growing at 2 or 3%. All of that is driven by OCP. So it's the right question. From our perspective, we have to plan for success to build this project ourselves. We would obviously look at whether or not we need somebody like OCP as a potential strategic financing partner, but we have no intention to sell the project to OCP at this point in time.
Okay, and that theoretical build, what's the timeline towards that?
Well, assuming that we're financed, it's a 2-year construction period, and so we will finish the feasibility study, as I said, in the first half of next year. We're commencing the ESIA process that leads us into the permitting. The ideal scenario is we would try to certainly have the permitting well underway next year and have it done by the end of next year. It may slip into the following year, and then that puts us in a position, assuming that we get the financing in place, to commence construction.
Okay.
So it really starts to boil down to how do these financing discussions play out. We've had a lot of interest on the debt side, and now it's really about working out how do we play the equity side. And there's been quite a lot of interest, and it's been very promising and encouraging from my perspective to see that interest from a variety of areas. And
just to finish up, fresh into the market very recently, there was a study, it looked like an SOP related study. What was that? How relevant is that?
So we're constantly looking at ways of potentially enhancing the margins of our project. So we actually put out a study monetising on the basis of monetising our salt byproduct as well quite a while ago. Showed that we produce quite a lot of waste byproduct salt, which is of a saleable standard into the de-icing salt market. This is really another addition into our product diversity mix. We're looking at converting about a quarter of the MOP from the Chemosit potash project into SOP via a Mannheim process. It's a fairly low capital cost way to do it. What's really interesting is the key drivers of success in a Mannheim development is access to sulfuric acid, access to heat, and obviously having a source of MOP that's secure. In Jor-Phosphate, it has one of the largest sulphur burners in the world and creates a huge amount of sulfuric acid. So you have a captive source of sulfuric acid, amazing location, and one of the world's biggest buyers of potash sitting on the doorstep. So it made a lot of strategic sense from a high level. what we did is wrap some really tight numbers around that, and the results, frankly, were outstanding.
So that's also going to feed into the feasibility numbers when they
So it's an addition to the feasibility.
Okay.
So it's really, the way we structure it is we're selling the potash to the SOP project at the same price as we assuming we'll settle it in Brazil or any other market. So no cannibalisation of margin to make that project look better. Okay. To give you a rough idea of the sort of numbers, sub $100 million of capital costs to produce 240,000 tonnes a year of product would make us one of the largest SOP producers in the world, and very, very competitive cash costs delivered to the US SOP market, margins in excess of 40%, and an NPV of well over $400 million. So really, really compelling numbers.
Okay. Hayden, Locke, thank you for your time.
Thanks, Chris.